Hi guys, my name is Matthew Cronin. I'm with NNN Investment Advisors. We're your NNN nationwide experts. We specialize in partnering with real estate investment trusts to get you an offer within 24 hours if your property meets uh, our REITs' investment criteria, and we get a commission agreement from you. We can get you an offer within 24 hours. That's NNNinvestment.com. Today we're going to be talking about sale leasebacks and why they're becoming a little bit more popular nowadays. Sale leasebacks, the whole premise behind them are that companies are primarily not in the business of real estate. For example, a corporate company like Rite Aid is not in the real estate business. They're in the pharmaceutical business. They're in sale of goods and whatnot. They don't necessarily care about real estate. So that's the premise. This is what happens during a sale leaseback. A company owns and occupies a property. So let's say a company owns a building on 5th Street and they need some quick cash. So this is what they do. They sell their property that they're using, that they're in, to an investor, like a real estate trust. The company sells the property and then leases the property back from the investor. So let's say they sell the property for $1 million. They now have $1 million on their balance sheet that they can use for things like investor buyouts or investing in a different property or growth capital for the business. They sell the property to an investor. That investor then leases the property back to them. So they're still in the property. They still occupy it. They still run it. They still pay rent. They still pay taxes. They still pay improvements on the property. But the company now has a bunch of cash on their balance sheet. This is popular with private equity companies who are not in the business of real estate. They're in the business of buying and selling companies. For those private equity companies, real estate owned doesn't necessarily count towards their EBITDA. If they sell the property, the money that they accrued from the sale can be counted and used for other investments or investor payouts or growth capital for those other companies. So it's a quick way to make some money and not necessarily be in the real estate business for them. The benefits of this, it's used as an alternate funding option. They now have a bunch of capital that they didn't have before. They can now the company can now write off their lease payments to the new investor of the building that they used to own as tax write-offs, tax deductible write-offs. And they can structure the deal where you can finance 100% of the value of the company. These are usually 10 to 15 year lease terms. So an investor buys the company and then signs a 10-year, 15-year lease with the company. And these are usually, most of the time, triple net leases. These aren't double net. You're getting your everything paid for as the investor. The benefit for the company is not only an alternate lending funding option, but tax write-offs and more favorable terms for the company that's now leasing the property. It's a win-win for both parties. If you're in venture capital, if you're in private equity and you like to sell your company's property that you lease and like to lease it back and keep the tenant in there and become the tenant and use those lease payments as tax write-offs. Sorry for the cutoff there. If you're a private equity company and you think one of your portfolio companies would like to do a lease buyback, then reach out to us. We're your triple net investment advisors nationwide. My name is Matthew Cronin, triple net investments advisors.com. Talk soon. Thanks.